folks, Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory. Thought we would come to you today with a brief market update, kind of let you know what's going on out there. S&P 500 right at about 58.75 for a level, and that's basically flat for the year. Although flat for the year is a little bit of a misnomer, given the sort of ups and down, topsy-turvy ride that we've had so far year to date. I would kind of remind people that we are up about 18% off the bottom. So almost, it's kind of funny, this particular market cycle, we almost officially got to a bear market. I think on an intraday for the S&P 500, we might have actually touched bear market territory. And we are almost to the point of, then subsequently establishing the next bull market on the other side of it. So once again, just highlights the kind of volatility year to date. But if you were to just pick up your statement, if you've been living under a rock for the last several months, you'd look at it and be like, not much going on. The year's flat from the equity markets. Bonds yielding, 10-year Treasury yielding right at about 4.5%. That's actually on the high end. As we've seen equities kind of rally, we've seen the 10-year Treasury sort of settle into a point pretty high, certainly high relative to this cycle. I think that is, once again, part of this whole, the Fed is on pause until they see what direction the data starts to flow in. Fed funds rates right about 4.5%, 10-year Treasury rates right at about 4.5%. I don't think that 10-year Treasury is going to move materially until we get a little bit better clarity, or at least a better sense from the market as to what direction the Fed's next move is. And if you look through the various sort of macroeconomic indicators, you'd see the CPI, that core CPI inflation number right at about 0.2%. You'd see the unemployment rate right at about 4.2%. So everything in this sort of hard data pointing to there's not really anything that we need to do here. Once again, with the Fed, sort of looking at the hard data and being on pause. Meanwhile, consumer confidence is really at almost all-time lows, certainly all-time lows for the last 10 years. People not feeling very good, and that number continues to get worse. And so I think that there is a little bit of foreboding, a little bit of a sense that the actual impact of the tariff situation won't really be seen until the coming months of economic data. Some sense that there may have been some pull forward in demand as people sought to buy stuff ahead of the tariffs. Maybe they slow down their spending now, as well as some potential impacts on unemployment and hiring as businesses kind of freeze a little bit with uncertainty in the overall sort of new tariff picture. So we will see how that data plays out. In the meantime, it is wait and see from the Fed. I would also just note, on Friday, we had the administration come out and say that, trade talks with the EU were going nowhere. And so the market shed about 1%. And then today we're getting that 1% back because the EU came back and agreed to, quote unquote, fast track the trade negotiations, whatever that means. I just think that this does serve to highlight, please don't let this market lull you into a false sense of complacency. Sometimes people, I think, when the market calms down a little bit, they start to assume that everything's okay. We are, and I think will continue to be, in a period of heightened volatility, particularly given that headlines drive the market as much as actual economic data. So, we're only one headline away from a move, 1% higher or 1% lower. In that environment, I think it's important for everybody to just understand that, we prepare our portfolios for volatility and that we would probably expect to continue to see that volatility throughout the remainder of the year. So with that, as always, if you have any questions, please feel free to reach out to myself or to your advisor. I hope you're having a great day, and I look forward to talking to you again soon.